October 15th, 1929. Irving Fisher stands before a crowded room of America's elite. Fisher wasn't a fool. He wasn't a gambler. He was the most respected economist on the planet, the man who practically invented modern monetary theory. He adjusted his glasses, looked at the audience, and delivered a sentence that would become the tombstone of a generation. Stock prices have reached what looks like a permanently high plateau. He believed it. They all did. 9 days later, the market fell 11%. 4 days after that, another 12%. By the time the dust settled in 1932, the market had lost 89% of its value. It took 25 years to recover. Here is the paradox. The people buying stocks in October 1929 weren't stupid. They had data, they had charts, they had the roaring 20s wind at their backs. They had just witnessed the greatest expansion of wealth in human history. They bought the top because everything looked perfect. That is the trap. A crash never happens when things look bad. A crash happens when things look so good that skepticism becomes a social crime. Look at your portfolio today. Look at the S&P 500. It feels safe, doesn't it? You've been told to buy the dip. You've been told stocks always go up in the long run. You are standing on Irving Fisher's plateau, but this time the cliff is twice as high, and the rocks at the bottom are much sharper. Let's zoom out, way out. Forget the daily noise, forget Nvidia, forget the jobs report. Look at the structure of the entire global financial system. Imagine a skyscraper. From the outside, it looks gleaming, steel, glass. It touches the clouds. But if you strip away the facade, you realize the beams aren't made of steel. They are made of debt. In 1929, the leverage was in the stock market. People borrowed money to buy shares. It was called buying on margin. Today, the leverage isn't just in the market. It is the market. It is the government. It is the corporate sector. It is the consumer. We are currently sitting on $315 trillion of global debt. That number is too big to understand, so let's visualize it. If you stacked $1 trillion bills, they would reach a third of the way to the moon. Now stack that 315 times. You have a tower of paper reaching to the moon and back 40 times. That is the scaffolding holding up your retirement account. And here's the problem. For 40 years, the cost to maintain that scaffolding, interest rates, went down. It became cheaper and cheaper to add more floors to the skyscraper. If you couldn't pay your debts, you just borrowed more at a lower rate. It was free money. But in 2022, the physics changed. Inflation returned. The central banks panicked. They raised the cost of money faster than at any time in history. The scaffolding is now rotting, but the building hasn't fallen yet. Why? Because of a psychological phenomenon I call the lag effect. It takes time for the rot to snap the beams. Right now, we are in the quiet pause, the moment after the coyote runs off the cliff, but before gravity notices he's walking on air. 90% of investors are looking at the view. They should be looking down. This brings us to the specific mechanism of your destruction. In 1929, the market was active. Humans made decisions. If a company was bad, people sold it. If it was good, people bought it. Today, we have destroyed that mechanism. We replaced it with passive investing. Index funds, ETFs, the 401k auto deposit. This sounds like a good thing. Low fees, diversification. It's what your financial advisor told you to do. But here is the dark side they didn't mention. Passive investing is blind. When you send $1,000 to an S&P 500 fund, that fund does not check if Apple is overpriced. It does not check if Tesla's earnings justify its PE ratio. It doesn't care. It has to buy. It is a mindless robot programmed to buy whatever is biggest. This creates a self-reinforcing loop. Apple is big, so the robot buys Apple. Because the robot buys Apple, the price goes up. Because the price goes up, Apple gets bigger, so the robot buys more. This is the circular mirror. The market isn't reflecting the economy anymore. The market is reflecting the money flowing into the market. It is a hallucination. Right now, passive funds own nearly 50% of the US stock market. That means half the market is on autopilot. It works beautifully on the way up. It feels like magic. But ask yourself this. What happens when the flows reverse? What happens when the boomers, who own the majority of this wealth, need to sell to pay for retirement? Or what happens when a recession hits and people lose their jobs and stop the auto deposits? The robot has to sell, and just like it bought without asking price, it will sell without asking price. There will be no one on the other side. In 1929, there were value investors waiting to buy the bottom. In the next crash, the value investors have been extinct for a decade. Liquidity is a coward. It disappears exactly when you need it most. You feel rich. Your house is up 50% since 2020. Your stocks are near all-time highs. But we need to have a difficult conversation about the difference between currency and wealth. They are not the same thing. Wealth is goods, services, productive land, factories, things that sustain life in society. Currency is just the claim check on that wealth. Since 2020, we printed 40% more claim checks, dollars. Did we create 40% more factories? Did we build 40% more houses? Did we find 40% more oil? No, we actually produced less. So if you have more claim checks chasing the same amount of stuff, the price of the stuff goes up. The stock market going up isn't a sign that companies are 50% more valuable than they were 3 years ago. It is a sign that the dollar is losing value. You are measuring your wealth with a ruler that is shrinking. This is the money illusion. In the Weimar Republic in Germany in the 1920s, the stock market went up billions of percent. Everyone was a billionaire in the stock market. But a loaf of bread cost 1,000,000,000 marks. We are not Germany yet, but the mechanism is identical. The government is running a deficit of 2 trillion a year. They are spending money they do not have to prop up an economy that cannot grow. To pay that debt, they have to print. If they print, inflation comes back. If inflation comes back, interest rates stay high. If interest rates stay high, the debt scaffolding snaps. It is a mathematical cul-de-sac. There is no exit. The only way out is a default. But the United States cannot default explicitly. We won't say we aren't paying. We will default implicitly. We will pay back the debt in dollars that are worth a fraction of what they are today. That is the trap. You are holding assets denominated in a currency that is being sacrificed to save the sovereign debt market. Economist Hyman Minsky had a theory. He said that stability leads to instability. When things are stable for a long time, people take more risks. They borrow more. They get comfortable. This confidence creates the conditions for the crash. We have had 15 years of artificial stability provided by the Federal Reserve. They suppressed volatility. They bailed out every mistake. This trained you. It trained you to believe that risk doesn't exist. It trained 90% of investors to believe that stocks only go up. This is the psychological setup for a 1929 style event. But the trigger won't be a random Tuesday panic. The trigger will be the bond market. The bond market is the smart money. It is 10 times larger than the stock market. Right now, the bond market is screaming. The yield curve has been inverted for longer than at any point in history leading up to a recession. That means investors are so scared of the future, they're accepting lower returns for long-term safety. They know what is coming. The Minsky moment arrives when the cash flow from the assets is no longer enough to pay the interest on the debt used to buy them. Think of commercial real estate. Office towers in San Francisco and New York are empty, but the debt on those buildings is still due. The owners are mailing the keys back to the bank. The banks are sitting on losses they haven't admitted yet. And who insures the banks? The government. Who funds the government? You. It is a circle of liability that ends with the destruction of the middle-class saver. So, here we are, standing on the plateau. The champagne is flowing, the band is playing, and 90% of the people in the room are dancing. They are fully invested. Long tech, long bonds, long the dollar. They are betting on the status quo. But you are watching this video because you feel something is wrong. You can feel the vibration in the floorboards. How do you survive a 1929-style unwind? First, you must break the psychological addiction to nominal highs. Stop looking at the dollar value of your portfolio. Start looking at the purchasing power. If your portfolio goes up 10%, but your cost of living goes up 15%, you are losing money. Second, you need assets that are not someone else's liability. Stocks are a liability. They depend on the company. Bonds are a liability. They depend on the government. Cash is a liability. It depends on the central bank. What isn't a liability? Gold. It is the only financial asset that is not someone else's promise. It has survived every empire collapse for 5,000 years. Commodities, energy, productive farmland, Bitcoin. These are hard assets. In a debt to leveraging, money flees from paper promises to hard reality. The 90% are holding paper. You need to hold rocks. Third, you need cash. Yes, I just said cash is trash in the long run. But in the short run, during a crash, cash is king. When the margin calls go out, everything gets sold. Good stocks, bad stocks, gold, crypto, everything crashes together. Having cash allows you to step in and buy the wreckage for pennies on the dollar. It allows you to become the smart money of the next cycle. History doesn't repeat, but it rhymes. And right now, the rhyme is deafening. We have the same inequality as 1929, the same speculation as 1929, the same delusional optimism as 1929. The invisible scaffolding is groaning under the weight of 315 trillion. The circular mirror of passive investing has blinded the market to risk. Most people will walk into this trap with their eyes wide open, staring at their phones, watching a green line go up. They will wait for the news to tell them to panic. By then, the exits will be welded shut. You have a choice. You can stay on the dance floor, or you can find the door quietly before the music stops. The storm is coming. Make sure you have an umbrella made of something stronger than paper.